Good morning, everybody, and welcome to this week's weekly analysis session, the Elite Traders Club on Monday, 8th of February. Well, what a volatile week on markets last week, particularly in the US, and one of the big Nasdaq stocks, LinkedIn, dropping over or well in excess of 40% after hours on Friday. So certainly expecting our markets to experience the brunt of that this particular week. The disclaimer: the content of today's presentation or any other Elite Traders Club material doesn't constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of the presentations, you must consider whether the advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. All right, let's get things underway and have a bit of a look. Obviously, we'll go through the market risk indicators of portfolio management. Hopefully, you've all had a chance to have a look at the watch list. There will be a couple of other additions this week as well, just starting to fine-tune the watch list a little bit as we go, remembering that as you receive or as you download the file, that it is editable. That is, if you make any changes, etc., you will need to save those. If you do happen to download it and find that you've mucked it up or deleted something, then just simply go back to the website and download another version. But hopefully the idea behind the new watch list is to try and make it a little bit easier for you to use, and perhaps not so much toggling between different screens and having to scroll all the way across to the right-hand side. So that's the intention of it. And also in there, you should be noticing some extra columns this week with the price volume volatility. And what I'm going to do is start putting in notifications when that signal happens to go off. And also with the close section, I'll be putting in risk to reward outcomes of trades as well, just for the purposes of keeping an eye on expectancy. We'll also go through and have a look at the benchmark indices and some Q&A at the end. So for the time being, the S&P ASX 200 is in very high risk. It was an extreme risk the previous week. You've got to remember that the market risk indicator it's a lagging indicator, and so certainly important to think about what you've learned about price action and keep that in mind when you're looking at any charts, and that includes the indices as well. It's only just ticked up into very high risk, so a slight improvement from extreme risk, but I think you'll probably find that at the end of the next couple of days it may well find itself certainly back down in extreme risk. The S&P 1500 is still in very high market risk mode at this point in time. Again, remembering if you're splitting your portfolio amongst the two markets and assuming you've got a 15% allowable drawdown in your trading plan, now that assumes that you are operating in a low risk environment, then what you need to do is be diligent and make sure that you're applying a market risk multiplier to that maximum allowable drawdown when you're looking at the market risk conditions. So if we were splitting our 15%, that's 7.5% allocated to each of the markets. And in the case in Australia there, we need to now apply a 20% market risk multiplier to half of that amount. So applying that to 7.5% means that you would be allowed a value at risk limit across your portfolio of 1.5%. Now, as I mentioned, that is likely to change over the course of the next couple of days, bearing in mind what's happened over the course of the weekend. In the US, we are still in very high market risk condition there on our S&P 1500 index. Same market risk multiplier, 20% of your 7.5% allowable means a maximum exposure of 1.5%. All right, just a reminder, don't forget the macroeconomics analysis sessions on Friday afternoons. They are recorded, so hopefully you've had a chance to have a bit of a listen to that over the course of the weekend. I'll certainly be making some changes to that, along with having a bit of a catch-up with Jeff Saffer this week and talking about some of the ways that we aim to make that perhaps a little bit shorter session, but perhaps a little bit more pointier and not quite so data dependent. So really thinking about some of the themes behind what's going on in the market, and really only focusing on the most important data that's coming out. And within the next couple of weeks, we will also start running some education sessions in the middle of the week in around about a week's time. And around about the same time, we'll also split the sessions to a Monday afternoon for the ASX and a Friday, a Friday afternoon for the ASX and a Monday afternoon for the US. So those of you only trading the Australian market, you'll be able to tune in over Friday afternoon or watch it over the course of the weekend in preparation for Monday morning. So you can have a bit of a sleep in, particularly for those of you over in the West who have been very diligent in getting up at 6 a.m. Mind you, a lot of people over there get up at that time of the day anyway, don't they? And then Monday afternoon for the US sessions. All right, so let's go through and have a bit of a look at our benchmark indices, as is the norm. Again, having a look at the ASX 200 and looking at our longer term moving average. In this case, it's 125. Whether you use 125 or whether you change that to a 200, I quite like using a 200 and seeing how that reacts with our price action. You'll see, over the past few weeks we've been talking about how the longer term moving average really starting to act as dynamic resistance. And if the market was going to rally, certainly this would be an area of resistance. But also thinking about price action in terms of old levels of support, once broken, tend to act as future levels of resistance. We've rallied back a little bit, and again, that's dragged our stochastic, our worm, just above the 20 level there. You'll see 20.08, and certainly that looks like dragging down as well. You'll notice the volatility. The volatility's been above its longer term moving average for quite a period of time, and you'll see that moving average, the volatility of the whole market, has just been increasing constantly since the middle of last year, and bouts of significant volatility continue to plague the market. Over in the US there, again, you'll see there I've got the 200 EMA on there. We're certainly well and truly below that level. Popped this circle in there a few weeks ago just to say, well, look, if we do get a bit of a rally, this is sort of the area where I'd expect it to perhaps come up to the old levels of support through here. Old levels of resistance. Certainly price action couldn't, there wasn't enough strength in the market to get it up to that level. We did have a couple of bullish days, but then we sort of had this bit of a doji in the middle, which is always a little bit of a concern. And then obviously a bit of selling off. A number of the bigger stocks in the market, particularly the stocks in the Nasdaq, your Apples, your Facebooks, your Netflix, your Googles, your LinkedIns, etc. Big stocks have really started to become really under pressure, and they've really sort of dragged the rest of the market down. That's probably what was holding the market up to a certain degree. Certainly a lot of stocks in the US very, very much bear territory. So something to keep in mind. Those of you who are active, on the shorter term time frames, there's certainly lots of opportunities in not just the American market, but also in the Australian market as well. Just remember, volatility is at high levels, and also if you're trading short term, there's nothing the matter with that. Just make sure that you're not allocating any more than sort of 5 or 10% at absolute maximum of your portfolio to that particular style of trading, because whilst volatility is very high, you're going to get big swings, and there's nothing more severe than a bear market rally, and you'll get that on what is referred to as short covering, and you can get significant up days. In fact, historically many of the market's biggest up days have occurred in bear markets, so you need to keep that in mind and manage your risk accordingly. But certainly when we're in these sorts of conditions, it makes sense to have a small portion of your portfolio allocated on the downward side, and therefore any profits that you've given away as the market's gone through transition, you've got a little bit of an opportunity to perhaps recap some of that as well. Right, so there are our two markets. What I'll do now is I'll just go through. Actually, I might go through and have a look at some of the other markets around the globe as well, and just get a bit of a feel for what's happening across the globe there. So that's the Dow Jones. That's obviously the biggest 30 stocks in the US. And interesting, perhaps if we just sort of zoom out and have a bit of a look where we are. Some pretty key levels here on the Dow as a broad barometer sort of index there. Now this is on a daily perspective. So what I'm going to do, I'm just going to swap over to a weekly perspective and just try and get a bit of a historical context in terms of what this market looks like on a longer term time frame. Key levels at this particular point in time, we're sort of around that 15,500, where we've had old support levels there. Again, remember, these levels, they're not paper thin. They tend to be zones, but it's really important what happens, when we get clear breaks below those levels and how the market responds, whether we're able to rally back up and remain above those levels, or whether we continue to slide to the downward side is a really important element of it. So you can see on here, we've had these rallies up, back down to a support level, big move up, back down to a level, move up again and down to a level. This is, from a technical point of view, if you look in a textbook, it's often referred to as your head and shoulders type of pattern. Now, typically, depending on which books you read and how you like to interpret it, your normal head and shoulder pattern that you get, you typically measure the distance from the head, if you like, down to the neckline. And then if we do happen to break below then we just basically extrapolate that distance further down. So, if we do happen to break below those particular levels and we can't rally and retest, then there's every chance that, we could get down to these levels at this point in time. So just something to be mindful of at this stage, whether or not that's going to happen. The last time we sort of had that type of formation and we entered bear market territory was way back in 2008. So this is at the end of the really nice bull run that we had, but you'll see the same type of pattern through here, where we've got left shoulder, head, right shoulder. We had a break, and then it was really what was going to happen after that, and we really tried really hard to come back up and remain above that sort of neckline, but we failed at that level, and then the market really capitulated at that point in time. So we're certainly nowhere near this type of level at this point in time. We really just need to wait and see what's going to happen over the course of the next few weeks along the way. So just bear that in mind. So that's the Dow, obviously the what you might refer to as the higher quality stocks. We'll just go and have a look at the Nasdaq Composite. So this is the big Nasdaq index. Similar type of scenario here. We've got these key levels at this point in time. We really want to remain above these levels. If we do happen to break, then it really just gets back to what happens once we break these levels. Can we rally and retest? If we do rally, how far can we rally up? If we only rally up a little bit and then start moving down, then that's not a good sign. Again, your technical analysis, lower peaks all the way through, and obviously acting as key points of supply in the market. So again, that's on a longer term time frame. Looking at things on a weekly, we've already had a look at the S&P 1500. The Japanese market, let's go and have a look at that on a weekly basis as well. Certainly they're doing everything they can to try and keep that market up, and you'll see that from a longer term point of view. There was a long period from 2008 all through GFC time, and it took a long time for the Japanese market to recover. Finally did, sort of into 2013. It lagged a little bit behind the US, coming back to those levels again. Importantly, again, similar sort of pattern, isn't it? I'll just go back there and put on the weekly and just have a look at those sorts of formations. Fairly bearish in the way that price action works. And again, points of supply, bigger point of supply, another point of supply. So we've got a key level, these old points of demand through here, which are just trying to hold up at this point of view in the Japanese market. You'll see here, old points of resistance act as future points of supply. So again, remember, it is a bit of a zone there, and it's going to be a matter of what happens after. Should the Japanese market happen to break below this level, whether it can go back and retest and get above that level, or whether it fails and we see another successive lower peak, which would certainly be quite bearish for that market. Needless to say, most of the markets around the world are in similar sorts of territory there. A little bit different in the case of the Chinese market, but again, still worth having a little bit of a think about. You might consider this to be a left shoulder, a head, right shoulder, a break. We've come back to retest what was the neckline and capitulated and fallen away. So that sort of price action is pretty bearish. The German market had been quite good for a long period of time, and I know that certainly through 2012 it just continued to move up very, very nicely, and perhaps looking to trade stocks on that particular market. Since then, again, we've come down to a pretty key sort of level, haven't we, where we're just testing these old support levels. Very big black candle there on the last week, and a bit of a telltale signs in these markets is these dojis here where just complete indecision and then you get a big sell-off afterwards. So very much bearish price action there. You get a rally. We've got a doji there. We had a gap down and a big sell-off. So certainly the price action there really struggling. That's the French market. Just zoom out a little bit and see where we are there as well. Again, below its a longer term moving average at this point in time. So that's bearish as well. And I think the other one that we've got in there, this is the Milan Interbank index here. This is the one on Italy. And again, if we just go and have a bit of a look and think about, this market's moved up. It used the longer term moving average to find a little bit of support. Since then, we've just fallen through there like a knife through hot butter over the last few weeks. So really slicing through there very, very quickly. And again, we've sort of got this rounding component here, a higher rounding component, and then obviously a lower rounding component again. So that's just a bit of a look at the indices around the world. I'm not too sure whether I've got on here the English. There we go. This is the UK market, and again falling below its the longer term moving average, and now that's starting to act as dynamic resistance. You'll see here that it tended to act as support on the way up, and now the reverse is happening there. All right, so let's go and have a look at the Australian market first of all. From last week, there were no trades that triggered from last week. There's a couple of stocks that I just wanted to go through and have a bit of a look at this stage. I'm just going to bring up this on the right hand side here. A couple of stocks that just for consideration, just for talking point more than anything. I'll go through and explain each particular chart one at a time. Saracen was one that came up in the watch list, and its price action actually looks quite strong. Interestingly, quite a lot of white candles in comparison to perhaps the previous 18 months. Good relative strength. Price action, last trough well above second from last medium term peak, so that meets our price action filter. The only element or aspect of this particular setup is this little green line above that if we go through and have a bit of a look, you'll see that this is a long-term peak. It occurred back in 2011, so it's certainly something that does need to be respected along the way. Once we get clear of that, where's the next long-term peak? Well, that is it. So we really just need to get through that at this particular point in time. So it's just a matter of waiting. We can't get our 2 to 1 that we really want as a minimum, ideally, before reaching that long-term peak. So that's a pass purely on the basis of that, but the price action is quite strong. Other ones that came up on the scan as well, SBM, St Barbara Limited. This is a gold mining stock. Some of the gold miners have been quite strong of late as well, and again you'll see that particular sector out of favour for a long time, and certainly the gold stocks were the easiest ones to short for a considerable period of time. Certainly, I think the fear factor in the market, there's not a lot of inflation around at the moment, so Your gold stocks are probably rising more on the fear factor than the inflation factor at this point in time. In terms of price action, last trough at or above second from last medium-term peak, and we'll just go through there and just put on the value line again for the newer clients. The low there of that trough, $1.33.5. The high of that peak, $1.32. So that trough higher than the second from last peak. The only thing, again, preventing us from taking the trade is we can't get our 2-to-1 into this longer term peak. So on the basis of that, we wouldn't be able to trade that particular setup. The other ones that were on the list there, I'll just go back up through those. Saracen we had a look at. One that does actually meet the bill is HUB, Hub24. Has actually been performing very, very strongly over the last, certainly over the last 6 months or so as a minimum. It does have a fairly wide stop, but again, you need to just adjust your position sizing on that. Let's scroll out and make sure that we don't have any impediments overhead, and you'll see there that there's a green line there, which is obviously overhead resistance, and that's coming in at around about getting close to the $9 level. So from that point of view, there's no other levels there in between that. This is just a medium-term peak over here. Remember, for a long-term peak, we've got to have a medium-term uptrend on the left-hand side and a medium-term downtrend on the right-hand side. So that's a fair distance away, and certainly in terms of risk to reward, we can get our 2-to-1 into that longer-term peak. The price action, okay, well, there's our last trough. There's our second from last peak. So certainly, whilst it did experience a little bit of a sell-off through last month in particular, it's found support above that old resistance level. So finding now points of demand coming in well above that old point of supply, which is quite bullish, and given the what's been happening with the rest of the market, good relative strength as well. So on stop order for HUB, HUB, on stop is at $4.85 with a stop loss down at $3.58. So that's outside of 2 ATRs, and it's also a minimum of 0.5% below that last medium-term trough. So still got a fair bit of work to do to get up to that particular level. Will be a fairly wide stop. Again, remembering the stop's based on not just volatility but price action as well. So you just need to adjust your position size accordingly. The other one that came up on my scans this particular week was CNU. So again, let's just zoom out and see where we've been on this. I'm at 100% at the moment, so stock's only been around for a few years at this point in time. In terms of price action, last trough well above second from last medium-term peak, so exhibiting really good relative strength at the same time. Structure of this particular trade, we've just got to get past that last medium-term peak. So to do that, we need to place an on-stop order 0.5% above that last medium-term peak. So the on-stop order comes in at $3.81 and a stop loss at $3.33. In the Australian portfolio, over the course of the last week, there were no trailed stops, which is not surprising given what happened on the market last week. Stop outs. There was one stop out last week, and it was on DMP. It was on Domino's Pizza. Now you might remember that we've had two setups on this over the last little while. The previous setup was down at 49.15, which was this setup through here. That setup, if you happen to get into that one, you're still fine because price hasn't closed below our trailing 3 ATR protective stop. However, those of you who may have got into it just recently, that second last candle there, the high there was 60.94. Our on-stop order was at 60.88. So you would have been just triggered in on there. And then last week, price coming down, closing below our initial 2 ATR based stop. So that's an exit. That means that's an exit at market this morning. And you'll see the price did come down a little bit lower during the course of last week, only to be pushed up late. So those of you who may have taken that trade recently, just that that recent market weakness has had us stopped out of that one, but the earlier one, we're certainly still in that. That was the only stop out from last week. No cancellations from last week either. There were a number of pendings from last week. They are still all valid. So certainly if you've got any of those on for this particular point in time, the price action of those is still valid. No cancellations as a result. The US, last week, there were 2 stocks that triggered from the pending list last week. One of those was HRL. So I'll go through and have a look at HRL Holdings. No, it's not that one, David. Typed in the wrong one. That one there, Hormel Foods. That's the right one. The other one being in Australia there. So there we go. So you'll see that, again, this is a stock where we've had a couple of setups. A recent setup there through $70. And last week, previous week, we had the nice white candle, which gave us a setup. Last week, it triggered us in. Certainly would have been nicer to see a more bullish candle on that, but given what the rest of the market's done, certainly not the worst of candles. So that's triggered, and so that will now be added to the watch list again as a second setup. So I'll be monitoring that all the way through to its conclusion as well. Another one from last week's pending was TSN. Which is Tyson's Foods, and you'll see triggering in there much better candles. So certainly, given the relative strength and big spike up there in all 3 time frames, and again, that's really just in comparison to what's happened with the rest of the market. So certainly nice to be triggered in on a nice white candle when the rest of the market is moving in the opposite direction. So Tyson will go into the open trades this particular week. There weren't any trailed stops in the US portfolio. There were a number of stop outs, so I'll go through those now just to have a look at those. JCOM, J2 Global was one which is now closed below its trailing stop. So really, or actually, the last setup there through 79.09. So the setup through this particular level through here. Again, the trailing stop there didn't actually come into effect because at no stage did it move above its initial 2 ATR base stop. Price is now closed below its initial 2 ATR base stop. So we need to exit at market tonight. That's on J2 Global. The other one that has stopped out was MKL. So I'll go through there and have a look at that one. And you'll notice just recently on that particular day, 8:37, the original stop is at 8:35. So we were still in that particular trade. Since then, it's flirted, trying to close below its trailing stop. It managed, its initial stop. It managed to hold its head above water, but last week, just closing 832.72 below its initial 2 ATR based protective stop. So that's an exit at market tonight. And the other one that got stopped out last week was LANC. So I'll have a look at that one, Lancaster Colony. Previous week, price came down. In actual fact, that was a stop out from last week because its protective trailing stop came up above its initial 2 ATR base stop. So that's the one that we need to take notice of. So last week closing below that, so that was an exit at market last week. That was on LANC. I couldn't find any new setups in the US market. Did anybody manage to find any new setups worth having a look at? Either in Australia or the US? Probably none. I scanned about 2,800 stocks in the US and around about 2,500 thereabouts in the Australian market. So certainly not a lot happening on the long side of the market, so the upward side at this particular point in time. Any of you at the moment doing any short-term trading? So I'll just throw that out there. Thanks, Kim. No setups for this particular week, so that's okay. No short-term either. Okay, that's fine. A couple of stocks in the US market that have been very, very bearish of lately. One of them I might just bring up, just have a look at LinkedIn. Let's have a look at that that's on a weekly basis. Massive candle. So last week, stock opening at around about $200 and closing down at 103. So certainly massive bearish price action there. Let's have a look at that on a daily point of view. Were there any telltale signs about this particular stock? Certainly this is to do with earnings, and their earnings actually weren't that bad. But again, obviously the market perhaps pricing in better than forecast earnings, and the whole, it just gapping down massively. So from a long-term point of view, would there have been any reason to be long on this particular stock? Well, if you think about the price action, etc., let's put on our ETC overlay for the US. Relative strength was holding up for a period of time. In terms of if we had used a trailing stop, anywhere through here, prices gone through, we would have been stopped out. Price action, any setups through here as an example. Well, there's a trough. If we just zoom in, there's a trough that was formed. That trough, if I just take the trailing stop off there for a minute, that trough was above its second from last medium-term peak. However, what would have precluded you from taking this particular trade is this long-term peak. So just a simple rule, observing, respecting a long-term peak, would mean there'd be absolutely no reason for you to be into this particular stock, even though the price action filter would have said, yep, that's okay. Relative strength would have said that's okay. Long-term peak says, no, we can't be into a stock like that. And just as well, because certainly if you hadn't been stopped out through here and you just thought, I'll just give it, one more candle or another more candle or whatever, and then all of a sudden getting a massive sell-off like that. So, certainly your price action, your rules there, keeping you out of a stock like that. Ken's asked, are we looking for shorts on daily or weekly charts? Well, certainly from the short-term trading point of view, looking at them on daily charts. That's just a weekly chart as an example there, just showing why you wouldn't be long on a stock like that, even though it was, in terms of relative strength, holding up pretty well. So if you're looking for shorts, as I say, volatility is certainly at extremes. If you're doing your short-term trading, certainly you can do it on on daily charts. You can even do it on longer-term charts, on weekly charts as well. So, from a weekly point of view, what's a stock that you know of that's been extremely weak on a weekly time frame? Other than LinkedIn, what are some stocks that you know of that have been weak and continue to just go down and down and down? ANN says, Ken, let's have a look on a weekly chart for Ansell. All right, so let's go across to the right-hand side and have a bit of a look. Again, this is on a weekly chart. There's a 40-week moving average there as an example. We can put on that 40-week is based on a weekly chart. That equates to roughly your 200-day moving average. You'll see through here that it tended to respect it reasonably well in terms of support, trying to hold up, falling through. What did it then do? Tried to rally back, couldn't hold. What else have we noticed about this that's really bearish? Successive lower peaks in particular. So really, in terms of just pure price action, I think it's always good to go back and think about your price action rules. Think about, these old points of supply, in the future acting as points of demand, capitulating, old points of demand now acting as points of supply. Price couldn't rally back up above those levels, and certainly not surprising to see a sell-off like that. Something bad happened during reporting season? Yeah, probably did there, Ken. Again, all the fundamentals behind these particular charts. You've got oil stocks and things like that. STO, Santos has been a stock that's been weak for a long period of time. So certainly very, very bearish. Interesting to think about, the bearishness of some of these stocks that, whilst price can go down, particularly in that oil sector, you can get all sorts of announcements overnight that can really have an impact, and stocks can move quite a lot in percentage-based terms in the opposite direction. So here we had Santos looking really good on the downward side, only to have a little bit of news. Russia pipes up and says something, or the Saudis say something, or whatever it may be, and stock price can go from $2.50 to $3.20 in a blink of an eye. That's a really significant movement in the opposite direction. So you need to be careful when you're trading on the short side, particularly as stocks get down to those lower priced levels as well. SGH, is another example there. That's Slater and Gordon. Now I'll have to go back because I think I might be in a watch list there, but we'll go and have a look at SG. Is it SGH, Slater and Gordon? Yeah, there we go. That's the one. So let's go and have a look at that as an example. And just the sort of movement that we've had in Slater and Gordon for a long time. At one stage, this was a terrific stock, and certainly you could have made a lot of money, really boosted your portfolio over hanging onto that stock for a couple of years. And look at the way that it really respected that trailing 3 ATR. Certainly gave you the signal to get out. And again, the trailing stop, having your exits are so much more important than your entries. And I think that's a really good reminder there that closing below that particular level, it's a real warning sign. And once it closes below, what does it do after that? It tries to rally back up, and it can't get above that trailing stop level. And you can do this. This is just a little bit of something else you might like to look at in your portfolio. Whether you're a shorter term trader or even a longer term trader, using a 3 ATR, so not our standard trailing stop one that we use for going long, but you can use another 3 ATR based stop. And I'll take our long only 3 ATR based stop. But this other one, the difference between this one is that this flips and flops from being above the price action to being below it. And it's a real telltale sign once a stock falls below that trailing stop level, that 3 ATR long short trailing stop, that when it tries to rally back and can't, what then happens afterwards. And you can bring up any number of stocks and go through and have a look to see what happens. So if we go back to, let's have a bit of a look at LinkedIn again. And just sort of see what happens. So as an example, really strong through here on a weekly basis. It broke through, and then what did it try and do? It tried to rally, and it couldn't, and it just capitulated. So really interesting to watch that type of behaviour, particularly as you get stocks that are starting to break down. So just go through and have a look at some stocks at the moment that are very bearish, particularly in the US. Just trying to think of a couple off the top of my head at this particular point in time. Let's have a look at Netflix. All right, so what I'll do is I'll clear the chart and let's put on that. So pretty interesting. Now this is on a weekly chart as well. That price came down below. This is a volatility type of trailing stop. below it. The trailing stop went above it, tried to rally back up to the, could never get back above that level and just fell away. So really worth remembering. Even on a short-term point of view, gets below this trailing stop. What does it try and do? It tries to rally back up. It can't. Then obviously any support levels along the way that just need to be breached, and extreme, bearish price action to the downside. So it's certainly one just to keep in mind, particularly on the shorter term time frame. Those of you who are looking to go short, one of the things that you're looking for in these sorts of markets is not to be going short down at these sorts of levels, because price is just so stretched to the downward side that this is where you start to get short covering, particularly down at these support levels, and getting rallies back up. So quite often what you'll find is a stock will come down, try and rally back towards that ATR trailing stop, only to fail at that particular point of view and then to be smacked back down again. So certainly anything on the bearish side of things, it's well worth looking at those sorts of stocks. A couple of others that we might have a look at. Amazon recently, just as an example, this is a big NASDAQ stock as well. That's on the weekly, so let's just clear that again. Okay, so you'll see that even on a weekly, it's been below the weekly for a number of weeks. What happened? It tried to rally, it couldn't, and that's pretty close to your classic 3-bar reversal. So it tried to rally, very, very bearish candle there, and then last week being smacked down. What does it look like on a daily? Well, again, it broke down below a trailing 3 ATR stop, and if you wanted to, you could put some moving averages, that sort of thing on it, or even shorter term time frame moving averages on it. Regardless of what the moving averages are doing, no sooner did it fall down below the ATR stop, tried to rally back up, couldn't close above it, gapped down, and boom, just sold away very, very heavily. So it didn't take much time to go from 650 down to 500 bucks. So again, seeing those failures at those previous levels, when you're short-term trading, they're the levels that you want to be starting to thinking about. Much lower risk trade at those levels than down here, where you really extended, and you're likely to get some short covering only to get a snap back. So just something that's worth keeping in the back of your mind as well. Any other bearish stocks? Anyone trading? What else have we got in the US? I've noticed of late that's been pretty bearish. A lot of the banks, Goldman Sachs. Again, we'll go through. Let's clear the chart and have a bit of a look. So, even from a weekly point of view, okay, we've broken down below the trailing stop. This is the long short trailing stop. Closed below it. Tried to rally back up. Couldn't. That's a blended candle there. Couldn't rally back above before being sold off really heavily. Going through, having a look at just even simply on a daily time frame, breaking through to the lower side, tried to rally back up, couldn't. Tried to rally back up a number of times and keeps falling away to the downward side. So certainly, seeing those rallies back up and failing is the market is telling you that it really wants to get out of this particular stock. So any rally, think about it. If you're holding this stock and you have to liquidate, where would you prefer to liquidate? At a lower price or at a higher price? And certainly that's the way that the institutions, the bigger players in the market, move their cash around. All right, so we've covered a few things today. We've had a look at the broader market indices and seen how the bearish nature of those. We've had a look at both portfolios, Australia and US. Covered some of the stop outs over the course of the week. We've had a little bit of a look at some of the shorter term price action, particularly to the downward side. ATVI is another very short bearish stock. I think it was ATVI on a daily point of view. So I'm just going to bring that in, and again, let's go and clear the chart and just have a look at something very, very simple. How well it respected that on the way up, broke through, tried to rally, couldn't. A little bit of telltale sign there, got smashed back down, and since then has really started to accelerate to the downward side. Would I short it at this point of view if I was a short-term trader? Certainly, look, you know, in the past you've looked at putting on your EMAs, etc., and at this stage it's only just starting to curve over, so our EMAs wouldn't be in the right particular order for that. But it's not going to take too much more price action for this to start ticking the boxes from a shorter term trade to the downward side. But just interesting to note how that trailing stop works. Okay, coming down, failing to rally, and then really capitulating. You'll see that in a lot of stocks where there's a lot of weakness, coming down, breaking, and then from that point of view, a bit of a rally, and then a failure, and then pretty quick price movement to the downward side. So again, it's not in your trading rules per se, but it's really just something as more of a observation that you might like to investigate further. If you do want to talk about that, happy to spend some time on the phone with any of you, going through that in a little bit more detail. But just remember, it's not in your trading rules per se. It is a little bit more of an advanced type of strategy. So for those of you who want any further information, feel free to shoot me an email, pick up the phone, we'll have a chat. All right, folks, I think that's about it for this particular week. Again, when it's times like this, you need to be protective of your capital. So don't go, overexposing yourself in this type of market to the long side. Remember, volatility is at extremes, and with your shorter term style of trading, again, just be mindful of the volatility, be sensible about it. Don't go chasing trades. The market will always be there. So just keep that in mind. Be sensible, and if you do that, then at some stage when the market turns around, there will be opportunities. Good stocks will recover quickly, and continue to hold up well. And that's something that a lot of stocks in the Australian market have held up very, very well. The question is, how long can they hold up for? So we'll just have to wait and see. All right, folks, that's it. Thanks for joining me this morning. We will catch up with you later on in the week, and trade well in between. Bye for now.